and the children are going to inherit the property anyway at some point. So this is just an early inheritance, and they now have that equity in their own home growing at whatever the home values are growing at. So it's just early inheritance is a big piece of our business these days.
Hello, welcome to another episode of Strictly Money, where we discuss financial topics that matter. I'm your host, Sejal Patel. Today, we are having a critical discussion about the retirement crisis in Canada. Did you know that the average Canadian age 65 plus has an annual income shortfall of about $20,000? You see, a lot of seniors are equity rich, and a lot of that equity is tied into their homes, except they are income poor. Jeff Thorsteinson is joining me today. He is from HomeEquity Bank, and he is shedding light on one innovative solution. You may have heard of it, the chip reverse mortgage. This is something that allows seniors to stay in their homes, but it also gives them access to much needed cash. Hi, Jeff. Thanks for coming on Strictly Money.
Well, thanks for having me, Sejal. I'm really looking forward to this. We had a quick chat a couple of weeks ago, and I've been anticipating our chat since then.
Yeah, I want to say I think a lot of people know about the chip reverse mortgage. I'm assuming they've seen the commercials, and I definitely want to get into how it works and who it's for and not for. But Jeff, one of the big reasons I wanted you to come on is to talk about the retirement crisis. I know you see and you have the data there. I certainly have a lot of conversations with people because, I help them with their financial journey. And one of the biggest concerns that I see is that people are really afraid of outliving their savings. And a lot of people are house rich and cash poor. And I want to get your thoughts. What are you seeing?
Well, we, from the on the ground perspective, we're seeing a significant increase in interest in terms of finding out more about CHIP. How can it help people in their retirement? Our business has probably quadrupled in the last, call it 4 to 5 years, driven by a pile of factors. But there's definitely a lot of interest out there in learning more about it. And I'm not going to jump into too much detail right now because we're going to go through a whole bunch of different questions and get into it. But we absolutely on the ground, we're seeing that interest. And then any academic or academically oriented studies are pointing to the need out there. And so there's lots to dive into.
The retirement crisis, I mean, you have some numbers here, which I thought was really interesting. The average mortgage value for those who are above 65 is about $100,000. And I have to say, Jeff, that actually surprised me because I'm assuming that they bought their home a long time ago. And I would have thought that at that point in their life that the mortgage would have been paid off. So, we always try to teach this in financial planning. You don't want to have debt going into retirement if you can help it.
That has been the core sort of financial planning tenet for years and years. But we've also told people to take out a HELOC in your later years of working so that you have almost an emergency fund, right? So a line of credit when you get into retirement, and you can utilize it and take it out before you retire, because once you're in retirement and your income is lower, it's harder to qualify. So people have also done that. And then what we found is that over time, when interest rates were particularly low, people would dip into that. Maybe you want a nicer vacation. Maybe you're helping the children, which is a huge thing, that get into the real estate market, or helping the grandchildren, or a whole variety of reasons. In those early years of retirement, they actually tap into that and then realize maybe they're in their 70s and all of a sudden I do have $100,000 in debt and interest rates are now significantly higher than they were. And this is now a challenge. And we see that on a daily basis. people have gone through that exact cycle and are now looking how could we help in that circumstance.
Yeah. I mean, there's so much that pre-planning, needs to be done. And it's one of the things that we try to hammer in, right? Is, plan early for your retirement. And sometimes it's easier said than done. But, one of the messages that I try to give is accumulation is hard. Trying to build wealth is hard, but I'll tell you what's harder: decumulation. you know, Being in retirement and making sure that your money lasts you and that you're able to draw enough income to provide for your lifestyle when you don't know what your health is going to be like. You don't know how long you're going to live. You don't know what the economic or political situation is going to be like. It's tough, Jeff.
It's extremely tough. And one of the elements that you mentioned is life expectancy, and that's increased significantly over the last, call it 10, 20 years. People are now living well into their 80s, if not their 90s. And all of our planning and previous financial planning, years ago was all around you'd live into your 70s. And so people are having to make the dollars that they save just last that much longer, being all the more challenging for them.
Yeah. You know what else stood out for me? I mean, you have, and I'm looking at one of the decks that you present. So, we talked about the average mortgage value, but the fact that about 39% of Canadians age 55 to 64 don't have an employer pension. So again, you got to figure out how you're going to make up for that income. So there's, a good chunk of people who don't have that. But Jeff, what worries me is these numbers are only going to get worse, because if you look at the generation younger, the younger generation, even I'd say below boomers, they're unlikely to have a pension. Their housing costs are way higher. Their mortgage debt is probably way higher than those who are probably in retirement and accessing things like a chip reverse mortgage.
If we think about what's happened over the last 30 years, pensions would have been the single largest asset on the household balance sheet. Individual savings, probably number 2, and equity in the home, number 3. And that has completely flipped at this point in time, where pensions are much less prevalent, and a lower, they probably moved to the 3rd position in the household balance sheet. Savings hasn't changed much, or if anything, it's less than it used to be. And home equity has now become the single largest element of the balance sheet. And so that, as we go forward, the generation that you're talking about, it's only going to continue, although pensions will be even less because nobody's introducing a defined benefit pension plan anymore. Savings are going to be constrained for the very reason you point out, that the cost of the home and the carrying of the mortgage is going to eat up the capacity to save. So that's not going to change or get worse. It will get worse. And then who knows what's going to happen with home values, whether they're going to rise, they're going to stay the same. Like it's a bit of a fool's game to try to predict the future on that.
Yeah. And I'm glad you mentioned that, because when I look at this and sort of that delta between, when someone bought the home and the appreciation, I think about my parents. They bought their home around $200,000. Well, it's worth well over $1 million, right? So if they needed the equity, which they don't, they have a huge amount that they can access. And to your point, I'm not sure if we're going to see that kind of delta or that change going forward, especially if someone's bought a house now for $800,000, depending on where you're living in Canada. Could it go to 2 million? I don't know.
It's hard to say and very difficult to predict the future on that. Whenever we try in our work daily, we'll run projections for clients, and we always use a very low housing appreciation number to make sure that we're super conservative. So 2 or 3%, but 2 or 3% over 20 years on $1 million house does actually add up. So it's hard to say where the housing values will actually end up for that generation. Now, the one piece to consider too, though, would be the intergenerational transfer. So your parents have seen significant rise in value in their home. but that and so has many, many, many others, but that will actually transfer. So there is some hope for the next generation, even though they're buying in at a very large, high level. There will be some inheritance to come at some point that could help alleviate that.
Yeah, and we are actually, seeing the greatest wealth transfer underway right now. Jeff, I don't know, I'm aging myself here, but I tell you, I remember when I first started in the financial industry, and CI mutual funds they were pitching the Boomernomics fund. And the idea around that was one of the ideas, they had many themes, but one of the ideas was that everyone expected seniors to downsize. They said there's no way they're going to stay in these big homes. They're going to downsize to something smaller. And these homes are going to open up to families. We don't see that. And I think for a variety of reasons, but a lot of people want to age at home, my parents included, because they're like, we don't really have other options.
I think absolutely. We thought that would happen. And I think people, if you'd asked them earlier in life what their retirement plan was, downsizing was absolutely part of that picture at some point, both from a financial and also a lifestyle perspective. But that seems to have changed significantly over the last maybe a decade. And I think COVID itself has sort of, sped that up or accentuated the change, but it was happening anyway. And I think there's a number of factors. People are living longer and healthier. So my own parents, I was just speaking to them on the weekend, and they're in their early 80s. And I asked, what does your Sunday afternoon look like? And it was all about, we've got a bunch of gardening to do. We've got to get the pool open. We've got to, et cetera, et cetera. Like there was nothing about sitting, and relaxing. And so I think they're very, very normal now. So people in their 80s, they want to stay in their house. They still want to garden. They still want to do all these various activities much longer in life than people used to want to do that. And so I think there's a sea change that way. I think there's a cost around downsizing. So when it's easy to say earlier in life, I'll just downsize and have a smaller place. But if you're living in a city that you love and you want to stay in that city, good luck downsizing and actually freeing up any significant amount of cash. It's not cheap to find another place. You typically also, if I'm going down, I'm going to make it nicer. So you're going to have a nicer place, but smaller. And so the cost of doing it is significant. And then there's a whole emotional toll of downsizing, leaving the house you love, the neighborhood you love, the memories you love. So when the rubber hits the road and it's time to actually do that, people are significantly resisting. And then layer the whole long-term care crisis, COVID related, that's kind of the nail in the coffin. People are not they want to stay in their house as long as they can.
Yeah. And we know that there is a cost to doing that because you're not freeing up capital, which is why HomeEquity Bank and this chip reverse mortgage is one solution. Jeff, we're going to take a commercial break to hear from our sponsors, BMO ETF. When we come back, let's get into how the chip reverse mortgage actually works. Welcome back. We've been talking about the retirement crisis and one of the solutions being the chip reverse mortgage. Jeff, let's go through how this works. And we have a board that's going to come up, but so those above age 55 can access this, and they can access up to 55% of their home value as cash. So maybe we can talk about that piece. What sort of factors would someone look at there to decide how much someone gets?
There's a lot to understand about the reverse mortgage, and there's an awful lot of misconceptions out there and sort of misunderstandings. So we spend a lot of our time educating advisors and clients about how it works. And most people, once they listen, they're quite surprised. And so there's a number of factors that I'll get into. The first one, as you mentioned, it's accessing up to 55% of the value of your home, beginning at age 55. So it's at 55 and 55. Now, what happens for a reverse mortgage is the older somebody is, the higher the amount that we can lend. And the basic concept is they will remain in their home for less time the older they are. So when somebody is younger at the 55 level, we will probably be lending somewhere in the 20 to 25% of the value of the home. Once somebody is up around the 80 years of age level, we would be lending at that 55%. So the older you are, the more you can qualify for. So that's the first piece. The second, we often hear people are afraid that they'll lose their home in a reverse mortgage. And we always clarify that a reverse mortgage is nothing more complicated really than a mortgage. It's just legally it's a mortgage. The only difference is that there are no principal payments required, and the interest payments are not required. They're added back to the principal and then paid at the end of the life of the mortgage. Now, because it's a normal mortgage, it means the bank, HomeEquity Bank, does not go on title. You, as a client, retain title to your property. We are simply a charge against the property. So it's impossible to lose your home because we are not on title. And so this is a huge misconception. The next part really is around rates. So the other thing that people feel is that a reverse mortgage is a high rate vehicle, and so stay away. The rates are too high. What's happened over time is that the rates have come much closer to conventional financing. So we are often compared against a HELOC, and today our rates are actually the same or even lower than typical HELOCs today.
Oh, that's interesting, Jeff. So your rates would not be similar to conventional mortgage rates then?
Our rates are a little bit higher than a conventional mortgage. So if a 5-year conventional today was around 5 to 5.5, our 5-year rate is just under 7. So we're about 150 basis points more than what conventional rates are. And these fluctuate, the gap can sometimes widen and sometimes narrow, but I mean, as a rule of thumb, we're probably about 150 to 200 basis points more than what a 5-year conventional rate would be. And then when we look at HELOC rates, we're the same or slightly less than what a HELOC would be.
Okay. It's interesting. I mean, if people have to access cash, this is certainly an option. The fact that they don't have to pay anything until presumably they sell their home. So for some, that's a big relief. I would think, though, that they do need to be aware of the fact that the interest does accrue, right? So if they borrow, say, $200,000, I'm going to say, they have a reverse mortgage around $200,000, and they're in their home still for another 15 years, they need to think about that because that accrued amount can add up.
The accrued amount, it will add up. The interest as it accrues, and then there's a compounding effect of that as well. So it does add up, and they do need to be very cognizant of that. We often find people will compare their options. So I could, if I need or want to access the equity in my home, I could do it through a HELOC. I could take out a chip, or I could downsize. And when we look at those three options, we find they end up being quite similar at the end of the day in terms of the cost, not only the cost from an interest perspective, but then also what's left from an equity perspective at the end of the day. Three options tend to be quite similar. And we can get into the spreadsheet analysis if we wanted to, but they are surprisingly similar. And it actually becomes a question of what's more important for the client at this point in time. And there's a really simple decision tree. Is it really important to me to remain in my home or not? Question number one. And if it's not important, I really don't care, downsizing may be your best bet. But if I really do want to stay in the home in the neighborhood, then you're into either a HELOC or a chip. And then the next question is, how important is cash flow? So if cash flow is super important to you, the chip is probably your right answer because it makes a significant difference in your cash flow. If you have lots of cash flow, then the HELOC is probably the right answer because you have the ability to carry that debt and pay that interest cost. So
yeah, you have control over what that cash flow looks like.
Yep.
Yeah.
So two very simple questions, and as you answer those, it'll lead you in the right direction in terms of what's the right product for me in my situation.
Jeff, do they get statements then?
Yes.
So they know, they're not caught by surprise. They know the accrued interest and that amount is going to be deducted when they sell their home.
Yes.
Yeah.
There's annual statements. It also is very clear what the interest from this year is and what's the accumulated interest. We have lots of clients that use CHIP for investment purposes, so the interest is tax deductible, even though you're not actually paying it. And so there's some very interesting financial planning aspects to that from a cash flow perspective. We also have, people think about the CHIP as sort of a last resort frequently, but we in the wealth world have an awful lot of clients that use it for more creative and investment related purposes. And so,
I was just about to ask you that because I have to think, so the investment piece is quite interesting if they feel like they can maybe generate more than what they're paying in terms of the interest. But Jeff, do people use it to be, say, the bank of mom and dad? Because that's become very popular as well, right? So I can imagine that they may want to draw this money and help their son or daughter buy their home.
That is one of our largest and fastest growing segments, if you will, of why people actually use the CHIP. It's to help the children or the grandchildren, and typically getting into the real estate market. They could cash out part of their investment portfolio and give that to the children, but they'd be having a big tax hit depending on the positions that they had. So why do that when I could take the equity out of the home and help the children? And the children are going to inherit the property anyway at some point. So this is just an early inheritance, and they now have that equity in their own home growing at whatever the home values are growing at. So it's just early inheritance is a big piece of our business these days.
And Jeff, can they pay a portion of the CHIP reverse mortgage back if they want? Like suppose, they feel like they need the income and then all of a sudden they come into inheritance and they don't need it anymore.
Exactly. So it again, we are just a mortgage. So there's a lot of features that are very similar to conventional financing. So you can pay up to 10% of the original loan amount every year. So you can do that over time. You can actually pay the interest if you want, and we do have clients that do that. We have clients that pay some of the interest. They may have been consolidating other debts and are used to paying a certain amount. So they will continue to do that. So that way the interest grows less, rapidly. And then, like conventional financing, if you sign up for a 5-year term and you want to pay out early, there's a penalty. We have the same sort of concept, and it's a declining penalty. So the longer you've been in it, the lower the penalty. And after about 4 to 5 years, the penalty is pretty much nothing. So at that point, if you did inherit and you wanted to pay it out, then by all means, go ahead and pay it out.
Yeah. Jeff, there's, you talked about that spreadsheet, right? And I feel like there's so many decisions that need to be made. So you don't go into this in isolation. And which brings me to the point, and you had mentioned it earlier, the importance of this being part of the entire financial planning process. And I'm a huge believer in financial planning. I don't know how you can function without it. Um, so advisors, CFPs or whoever it may be, must play a key role in being able to evaluate all of this. Do you want to downsize? Do you need a chip? Is a HELOC better? What has been your engagement with the advisory industry like?
So my role at HomeEquity Bank has been to establish and grow our financial advisor distribution channel. So
Oh,
basically,
okay.
engaging with advisors and educating on CHIP and how it can fit in with a plan. And we are a year and a half into this project, and it's going very well. There's a growing amount of interest. Like, advisors realize there's something here that they need to understand more, and they need to understand how can they fit it into their clients' financial plans or retirement income planning. So growing interest, and then I was going to mention something else, but it's just sort of disappeared from my.
Yeah. No, the growing interest, well, it has to be there. And I'm wondering, is there a way to weave this into some of those financial planning softwares? You have Navaplan. I don't even know if Navaplan exists anymore, but there's Conquest, there's Voyant, there's a few out there, but I would think that there would be a need for this.
Yeah, interesting, because the equity in the home, typically in a financial plan, the equity in the home is sort of put over there, and it's not. Let's consider your assets. You have your pension plans, you have your public sector plans, CPP, OAS. You have your investments. Oh, and you have home equity. Well, let's not touch that, and let's not include that. And that has been kind of the approach in financial planning. But there is this growing recognition that we need to actually incorporate it in the whole plan. And these software programs actually do have the ability to incorporate it, but it's frequently not turned on. And so part of what we do and encourage is to let's get that turned on so that it's actually can be captured right in the plan itself.
Yeah, I would think that there would be a need for it. Jeff, can I ask you this? Who is the chip reverse mortgage not for?
I was going to, if I approached it from someone that needs it, like from a needs based, in other words, my investment portfolio is not significant enough to support my life, then it would be those who are struggling with cash flow. They're not generating enough out of their investment portfolios. That's who it would be for. And then if you were on the flip side of that, I have significant assets, that it's not for those. Except that sometimes it makes more tax sense to leverage equity in the home versus out of your investment portfolio. So even for those folks, it can be a tool. We do find, though, some people sadly have taken on they have way too much debt, about 80% loan to value, for example, in their home already. And we can only lend up to 55%. And so if somebody's sort of gotten themselves into trouble, if you will, in that sense, we're not a solution. Like, they've kind of gone too far. So unfortunately,
if it's the average age is whatever, 55, but what if you have a spouse that's much younger? Does that affect who gets?
Yes, it does. Absolutely. So, it's like a joint last to die insurance policy. So whomever is going to be in that home the longest is who we have to base our decisions on. So if you had a male 70 years old and a female 58, we would have to lend to the female who's 58, because she's the one that would stay in that home for the longest period of time. So our decisions are based on her.
Okay, that's good to know, right? So that means the value would be less that they would qualify for.
So we would be able, yes. And so we do encounter those situations fairly frequently, and then there's disappointment with the clients because they were assuming closer to 55% of the value of the home, but because the lady is much younger, it's much lower. And so so big age discrepancies are challenging. Unique properties also. So we have lots of people, particularly in the wealth world, may have acreages or cottages on Muskoka, those types of things. And as a lender, those are always a bit challenging to finance. So really big age discrepancies, unique properties, age differences, those can be a little bit more challenging for us.
Well, I always say, you know what, start the conversation, right? So you don't know what you don't know. And at least by starting the conversation and asking these questions, you'll know what tools are available to you. So for those of people who are watching this or listening to this on the podcast, where do they start? Is there a number that they would reach out directly to HomeEquity Bank? Can they go through their advisor?
Yeah, the best, from my perspective, the best is to talk to your advisor. Mm-hmm. And we have a team of sales professionals across the country that work with advisors, and the advisor can then bring us in to find out more and get into the exact situation and take a look at it. So that we like the advisor being involved because you're incorporating it into your complete financial plan.
Which you have to. Yeah.
Which you have to. And the advisor can look at all the options and make the choice or the recommendation for the client that is optimal for that client. And so we strongly encourage, talk to your advisor, and then they can in turn get us involved.
Okay. Jeff, we're almost at the end of the show, and you may not know this, but I always ask my guests 3 rapid fire questions. So are you ready to play?
I'm ready to play.
Okay. What is the best financial advice you've ever received?
Okay. My brother-in-law. Can I say 2 things?
Sure.
My brother-in-law, who would be known to a lot of people, he'll remain nameless, but known to a lot of people that might watch this, gave me 2 great pieces of advice. He said that, one, people will fall into one of 4 boxes: high income, low income, high spender, low spender. So if you fall into 2 of those boxes, you're going to be fine. So high income, low spender, you're fine. Low income, low spender, you'll be fine. The other 2 boxes can be more challenging. If you're high income, high spender, you could get yourself in trouble. And if you're a low income, high spender, you're definitely getting in trouble. So make sure you're in the right boxes.
Basically, spend less than your means, right? Like,
yeah. Spend less than your means. That was ultimately the point. And the second one was maximize your expenditures on appreciating assets, minimize your expenditures on depreciating assets. So
That's a good one.
Yep.
Those are really good ones. And I like the box idea. I may have to steal that one.
You could steal it.
That's a really good one. Yeah. And, and I when I teach this and I have online courses, I talk about the concept of good debt versus bad debt. I mean, good debt is not the right term, maybe productive debt. But it's true, right? I think too many people get into trouble because they're spending money on things that depreciate.
Yeah, that's exactly it. Yes. Yep.
So then I'll flip this. What is the worst financial advice you've received?
Okay. It came from the same guy, and I feel like I should probably name him, but
you can tell me after.
Back in around 2000, the advent of the internet and all of that stuff, internet-based companies was the thing, and you had to get on board, right? So it was the whole fear of missing out and the tech bubble and blah, blah, blah. So he decided he had to get involved and he couldn't miss out. So quit his investment banking job and started up some internet thing. I didn't have any money at the time, but I didn't want to miss out either. So I had to invest in it. And of course, we lost everything. So so the same guy has given great advice and then not so great advice.
Yeah. Do you feel like that comes down to really just risk management? Because you don't know. It could have worked out very well.
It could have worked out very well. And I think it ultimately is around chasing kind of returns, right? Because it was at the time, it was the thing. And so you have to invest in whatever the thing is. Had you gotten in earlier with a better idea, maybe, but chasing the return and, sort of whatever the market is blowing and just trying to chase that is not exactly a great recipe. If you're ahead of the curve, great. But if you're following, not such a great idea.
Okay, my last question. If you could enact a law, or if you could just give seniors a piece of advice that would help them not outlive their savings. So it could be a law or a piece of advice. What would it be?
Well, probably go back to that whole point about the appreciating versus depreciating assets, because we do see a lot of seniors that they spend a lot of money, particularly in the early go-go years of retirement, not wisely, like spending on a lot of things that, a more fancy vacation, for example, or splurging on the grandchildren more than you really can afford to. So I think the piece of advice is really operate within your means, understand what your means are, and understand that, the longevity could be significantly longer than you're planning for here. So be conservative in that respect.
Yeah, I couldn't agree more. I think, a lot of people underestimate how long they're going to live, and they underestimate how much money they're going to need in retirement. So great way to end the show. Thank you so much, Jeff, for coming on today. Really appreciate it.
All right. Well, thank you for having me. I really enjoyed the conversation.
Well, that does it for this show. Don't forget to subscribe. If you haven't, leave a review. Please share this episode and check out the previous ones so you can build wealth and wisdom. We'll see you back here next time. Stay well, stay wise, and stay wealthy.